Omega Healthcare Investors and Medical Properties Trust, two companies that both offer good yields above 5% for that nice dividend income. The burning question though is, which of these two REITs would be the better stock to buy? Medical Properties Trust offers a nice 5.5% yield. It's the second largest non-government owner of hospitals in the world with 442 properties all over the world. Omega Healthcare Investors offers an even higher yield at 8%, has 17 years of consecutive dividend growth, and is the largest skilled nursing facility focused REIT. But who are these two companies and are these dividends even safe? Medical Properties Trust is a real estate investment trust or REIT that invests exclusively in hospitals. They have tenants in general acute care, inpatient rehabilitation and behavioral health. With 442 properties and 52 operators in 34 states and 9 different countries, MPT is a very well diversified REIT. Important with REITs is under what type of contracts they lease out their properties to tenants. Medical Properties Trust leases out their properties as absolute net lease contracts with 10 to 20 year terms. This means that the tenants bear all costs, including maintenance, repairs, utilities and taxes. This offers MPT reduced risk as they don't have to pay for maintenance and other pricey costs that come with owning a property. To protect MPT from inflation, their contracts also have built-in rent escalators, ensuring a recurring growing income stream. Another way REITs grow is through acquiring new properties, and with 3.6 billion in investment in 2020, MPT made significant progress in that field, growing their assets or properties to over 21 billion. In fact, their assets grew on average by 31% per year in 10 years. A Medical Properties Trust has plenty of future growth opportunities as well, with the US hospital real estate market estimated to exceed $1 trillion. Internationally, the need for healthcare also keeps increasing, which provides more opportunities for MPT as well. One risk to consider though is that one operator, Steward, brings in over a quarter of the revenue, which increases single tenant default risk, something MPT intends to decrease over time. And what about Omega Healthcare Investors? This REIT is mostly focused on skilled nursing facilities and is banking big on what they call the silver tsunami of the baby boomer generation reaching an age where they have increased medical needs. The dividend of OHI is higher for a reason, because they do face some risks with a few of their tenants that are having difficulties to pay their contractual rents. The tenants of Omega Healthcare face some headwinds such as the increased wage pressures and the migration to Medicare Advantage, which results in lower reimbursement rates and lower lengths of stay, meaning less money for the operators of OHI. And of course the current pandemic, which led to reduced occupancy rates due to restrictions and fear of outbreaks inside the facilities. On the other hand, OHI believes these headwinds are moderating, and they expect that the silver tsunami will hit in 2030, where more and more people of the baby boomer generation will hit the age of 65 plus, causing an increase in healthcare needs, which is expected to drive multi-decade increase in demand for skilled nursing facilities. Nonetheless, the current situation is that during the last quarter, 2 operators have approached OHI because of their inability to pay future rents, which has been a story OHI has been battling with for the last few years. I do believe that the skilled management team of OHI will find a solution, but this does increase risk, hence the higher dividend yield. Enough about the companies, let's look at some financials. The market cap, which is the share price times outstanding shares, is at 8 billion for OHI and 12 billion for MPT. REITs are not known for huge increases in share price, and that is also what we see with these two REITs. MPT has increased 42% in the last 5 years, while OHI has decreased 8% in price. Volatility compared to the overall market can be measured by the beta. This is quite close with OHI at 0.84 and MPT at 0.87. With a higher market cap and way better price performance, Medical Properties Trust wins this first round. So how safe are those dividends? Omega Healthcare has a current yield of 8% and has increased their dividends for 17 years in a row now, but their 5-year dividend growth rate is at only 3%. For REITs, we look at the AFFO payout ratio to determine the safety of the dividend. For OHI, this is at 86%, which is on the high side but still okay for a REIT. The dividend safety score of OHI is also downgraded to 40, meaning unsafe. This has to do with the proposed vaccine mandate coming from the Biden administration. This would put increased wage pressures on the tenants of OHI. Medical Properties Trust has lower current yield at 5.5% and has increased their dividends for 8 years, with a 4% dividend growth rate. The AFFO payout ratio is looking better as well at 68%. MPT has a dividend safety score of 70. Boy oh boy, Medical Properties Trust also wins the second round based on a better and safer dividend profile. We got the revenues of Omega Healthcare here. The last 4 years have been quite flat and they are actually below the level they were in 2016. The operating margin looks much better at first sight with 51%, but again is quite downtrending. For a REIT we look at the funds from operations instead of the net income. So for Omega Healthcare this went from $3.08 per share in 2015 to $3.11 per share reported for Q2 2021. The adjusted funds from operations looks a lot better, going from $2.81 per share in 2015 to $3.06 per share in 2020. The reported AFFO per share was 0.85 for Q2 of 2021. At this point you might be wondering why I invested in OHI, because these numbers do not look that good at all. I will get back to you on that one. Then Medical Property Trust. Completely different story when it comes to revenue growth at least, with a nice steady uptrending graph. Margins also look quite a bit better at 66%. Nicely growing FFO per share as well, from 1.26 in 2015 to 1.65 in Q2 of 2021. The AFFO per share went from 1.17 in 2015 to 1.21 per share in 2020, and 0.34 per share in Q2 of 2021. So the AFFO growth is not that fast. Let's look at the score for the financials round. Revenue growth, MPT. Margins, again, MPT. FFO, boom, again MPT. AFFO growth, surprisingly, OHI. REITs, such as Omega Healthcare and Medical Properties Trust, are a bit different than normal companies, as they typically use more debt to fund their growth. Nonetheless, it is still important for REITs not to be over-leveraged. In other words, have too much debt. One way to measure that is by looking at the debt-to-equity ratio. The lower, the better. For Omega Healthcare, this is at 1.32 and has been trending higher the last few years. MPT is a bit lower at 1.21, but has also been trending higher. Another way to look at the debt is the net debt to EBITDA ratio, which measures how many years of cash flow it would take to pay off its debt. For medical properties, this is at 6.71, so it would take them almost 7 years to pay off their debt. Omega Healthcare has a ratio of 5.05, so for these ratios the roles are reversed and Omega looks better. This has to do with the fact that the debt of medical properties grew much faster than their EBITDA in the last few years, whereas Omega Healthcare kept their debt relatively the same, and the EBITDA did not increase much but was still quite steady. Short-term debt can also be a risk if it cannot be paid off in time, and could be a first indication of more trouble to come. For that we can take a look at the current and quick ratio, where a ratio above 1 is considered as the threshold. Both Omega Healthcare and Medical Properties have a good current and quick ratio well above 3. Omega Healthcare even has a ratio above 4 in the last quarter. Good to note here is that both companies are both healthcare REITs, but the type of healthcare properties is completely different. Medical Properties invests in hospitals, which I would think are typically bigger investments and thus require more capital than skilled nursing facilities of OHI. Another big difference between normal companies and REITs is that REITs are also dependent on the health of their tenants. So let's take a look at that. Some tenants of OHI have been struggling, but the rent coverage measured in EBITDA and EBITDARM overall has ticked up in the last quarters of 2020. Important to understand is that OHI has more tenant diversity compared to MPT, somewhat mitigating the risk of a single tenant defaulting. The rent coverage of the operators of MPT is quite a bit higher at 3.1 at the end of 2020. And importantly, since Steward Health is by far the largest tenant when it comes to rental income, they have a coverage of 2.4. On the balance sheet front, Omega Healthcare looks slightly better with a better debt to EBITDA ratio and a slightly better short-term debt ratio. The health of the operators is quite a bit better for MPT, so they win that part of this round. Investing and acquiring new properties is a big part of growing rental income or revenue for REITs. So we would also like to know how good both these companies are with turning capital into returns. For that we can look at the return on invested capital. This is also a way to measure the quality of the management. Omega Healthcare seems to be a bit better with generating higher returns, as the return on invested capital is at 4%, but has been much higher in the past. This also has to do with the challenging current healthcare environment, which cuts into the ability of the tenants to keep paying rent. Medical Properties is at just a bit under 3%. REITs need debt to grow, and in order to be able to issue debt at cheaper rates, the credit rating matters. For Omega Healthcare, the S&P credit rating stands at BBB, whereas MPT is at BB+. With a better return on invested capital and a better credit rating, OHI is the winner of this round and they are starting to catch up to MPT. But are these companies even a buy right now? Investing in REITs usually gives you higher than average dividend yields because of the way they are structured. They are required to pay out 90% of their taxable income as dividends in order to qualify as a REIT. The current yield of Omega Healthcare is at almost 8%, and with that it is right around fair value, whereas the 5-year average yield is at 7.8%. Medical properties is overvalued by quite a bit with a current yield of 5.5% and an average 5-year yield of 6.1%. But let's double check that on another side. Finbach shows OHI to be right around fair value, but MPT is undervalued with an upside of about 11%. Another way to value a company is to look at the price to FFO or funds from operations. This is the REIT equivalent of the PE ratio, but we also want to factor in expected growth to get a completer picture, don't we? Otherwise we would be putting the same value on a company that right now is the same price compared to the profits, FFO, but has way better growth expectations than appear with the same current price to profits. For REITs we have the price to FFO growth. MPT is looking pretty good here thanks to the high growth expectations of 12% over the coming 2 years. They are right around the ratio of 1. OHI is quite lower because their growth expectations for the coming 2 years are at 3%, and they come out at the ratio of 3.4. Do note that both are much better valued on this metric than for example realty income at 4.54 or store capital at 8.6. Of course, both are in a completely different industry, but just to give you an idea. The valuation round gives us quite mixed signals, where Omega looks better based on the dividend yield theory, but MPT is looking much better valued when looking at the price to FFO growth, and Finbach's. Therefore, MPT wins this round as well. We are not buying a company for its past performance though. As a shareholder, we want to be part of future profits so those profits can be distributed to us. Omega Healthcare expects to double in size in the SNF market in the next 10 years, banking on the silver tsunami and moderating current headwinds such as wage pressures and unfavorable demographics, bringing the occupancy of their tenants down. The growth for the adjusted funds from operations or AFFO per share estimates for the coming 5 years come out at 12% for Omega Healthcare investors. For Medical Properties Trust, the growth opportunities are focused on further international expansion. They name Australia, Switzerland and Colombia as new and compelling markets for them to invest in. Of course, this also brings extra risk, as they are not as familiar with the intricacies of these markets as they would with other markets they have been investing in a while for already. To put this into numbers, the estimates for AFFO over the coming 5 years come out at an expected growth of 32%, so much higher than that of OHI. To me personally, the biggest investment thesis for OHI lies in the further future, from 2030 and on. Until that happens, I keep collecting dividends from them, which I think they will be able to keep safe. But I like the combination of current income and the potential it can give me later on. The future round is also won by Medical Properties Trust, with a way better expected growth rate. That also means Medical Properties Trust is the clear winner of this battle. In the past, I also made a video comparing Omega Healthcare investors versus National Health investors. Click on this video to the right to see how that epic battle played out.